Many misunderstand consumer credit growth's true economic impact. Imagine you're at the mall and decide to buy a new TV with your credit card instead of paying cash up front. That's consumer credit in action, borrowing money to make purchases. When many consumers borrow money to spend on goods and services like this, it can stimulate economic activity by increasing demand for products and services. Now let's talk about why this matters. Consumer credit growth indicates the extent to which consumers are borrowing to finance their purchases rather than paying in cash. It serves as an indicator of our willingness to spend now and repay later. But here's where things get tricky. Every time you use your credit card or take out a loan, you're contributing to the total amount of consumer debt. This number can grow rapidly because increased borrowing often leads to higher spending. So let's break this down. When consumer credit grows rapidly, it often indicates that people are purchasing goods and services with borrowed money rather than cash on hand. This can be beneficial in the short term as it helps stimulate business activity and supports economic growth. However, if sustained over longer periods, rapid consumer credit growth can become a warning sign, potentially leading to increased household debt levels and financial instability. Think about it. When consumers consistently spend more than they earn, the consequences can be significant. This behavior can lead to increased debt levels and financial instability, making it important for individuals to manage their credit responsibly. Let's look at some numbers to see how this works in real life. In 2019, U.S. consumer credit growth was around $453 billion. That's a significant amount of borrowed money. But fast forward to the start of the pandemic in early 2020, people started borrowing even more as they lost jobs and needed cash. So how does this affect you? If you frequently use credit cards for non-essential purchases, your debt can accumulate rapidly. As payments become due, managing that debt becomes increasingly challenging, much like a snowball rolling downhill, growing larger and more difficult to control. Now let's talk about why this is important. The amount of consumer credit in an economy can indicate the financial health of consumers. When people are borrowing more and saving less, it often suggests they're taking on increased levels of debt. And when economic conditions deteriorate, this higher level of debt can exacerbate financial difficulties for individuals and households. For example, during the 2008 financial crisis, many homeowners took out adjustable-rate mortgages, ARMs, that offered low initial interest rates. As broader market interest rates increased over time, ARM borrowers faced higher monthly mortgage payments, which many could not afford to pay. This led to a surge in defaults and foreclosures, contributing significantly to the economic downturn. So how does this affect you today? Let's say you have a credit card balance of $1,000. If that stays unpaid for 6 months and the annual percentage rate, a PR, is 24%, it grows to about $1,386 because of interest charges. That's an increase from $1,000 to $1,386 over half a year, which represents a 38.6% growth in that period. Now let's take this one step further. When consumer credit growth is excessively high, it can contribute to inflation. Inflation occurs when the general price level of goods and services rises over time. As consumers borrow and spend more, businesses may increase prices due to higher demand. So here's a question. Do you think it's okay to spend money on credit just because your friends or family are doing it? Consider this. If many people around you are buying things they cannot afford with borrowed money, it could be an indicator that the economy is becoming unstable. Now let's get into how consumer credit growth can impact interest rates. As consumers borrow more and businesses observe increased demand, lenders may respond by raising interest rates to mitigate the associated risks of lending in a tighter credit environment. Higher interest rates make borrowing more expensive for everyone, particularly affecting those who are most credit constrained. For instance, if you have a car loan with a 3% interest rate today, but that rate could rise to 5% in 6 months due to rising consumer credit growth, your monthly payments would increase by about $16 on a 3-year $20,000 loan. That's significant. So what can we do? Understanding the amount of credit you're utilizing and managing it effectively is crucial. If you keep track of your debt and adhere to a budget, you'll be better prepared for any financial changes. Now let's look at why consumer credit growth affects the broader economy. When consumers are increasing their borrowing, businesses often interpret this as a signal of rising demand for goods and services. In response, they may choose to hire more workers or invest in new equipment, which can create jobs and boost economic activity overall. But there's a downside. When this cycle gets out of control, it can lead to asset bubbles. An asset bubble occurs when the prices of certain assets, like stocks or real estate, rise rapidly beyond their intrinsic value based on unrealistic expectations that the price increases will continue indefinitely. For example, during the dot-com boom in the late 1990s and early 2000s, investors poured money into technology startups despite uncertain prospects for these companies. This heavy investment created a significant stock market bubble which later burst as realities of the unstable foundations of many tech firms became clear. So how do we avoid contributing to credit bubbles? By being mindful of our borrowing and spending habits. Managing debt levels prudently and focusing on saving for the future can help you be better prepared in case an economic downturn occurs. Now let's talk about the long-term effects of consumer credit growth. When people consistently borrow more than they earn, it can lead to a cycle where they become reliant on borrowed money to maintain their lifestyle. This is often unsustainable in the long run because eventually, lenders may stop extending credit due to risk factors like high debt levels and low savings rates, making it difficult for individuals to manage financial obligations without additional borrowing. For instance, if you have multiple credit cards with balances that continue to grow, your overall credit score might decrease over time. A lower credit score can make it more difficult to be approved for new loans or to secure rental housing in the future. So here's a concrete example. Let's say you start off with $500 on one card and by the end of the year, it grows to $1,500 due to interest charges alone, assuming no additional spending. This kind of growth might seem small month to month, but can add up quickly over time. Subject: Consumer Credit Growth Basics Passage to Fact Check. Now back to why consumer credit growth is important for understanding economic cycles. When this growth slows down significantly, it often signals an upcoming recession. As businesses see a decrease in consumer spending, particularly through credit, they may respond by cutting costs, which can include laying off workers or reducing investments. A real-world example of this happened during the early 2001 recession, when many dot-com companies laid off employees due to a sudden downturn in consumer spending and investment. So what can you do? Stay informed about economic trends and be mindful of your personal financial habits. If you notice signs that indicate an increase in overall consumer credit growth, such as widespread borrowing or high levels of debt among people around you, it might be a good time to reassess your own financial situation. Now let's talk about some specific types of consumer credit: credit cards, auto loans, student loans, and mortgages. Each type comes with its own set of risks and potential benefits. Credit cards offer convenience but come with high interest rates if balances aren't paid off in full each month. Auto loans help you purchase a car but add monthly payments to your budget. Student loans enable you to pay for education up front but can result in significant debt that may take years to repay. Mortgages allow you to become a homeowner, which is generally beneficial for long-term wealth accumulation, but over-leveraging yourself can be risky. So how do you know what's right for you? Start by assessing your current financial situation and goals. If you need the money now and are confident in your ability to handle the payments later, it might make sense to take on debt. But if you're unsure about your ability to pay back what you borrow, it's best to avoid taking on more credit. Now let's look at how consumer credit growth impacts inflation. When consumers borrow and spend more, it increases overall demand for goods and services. As businesses observe this higher demand, they may raise prices, which can contribute to an increase in the general price level over time. For example, if you notice that grocery or gas prices are increasing more rapidly than your income, this could be due to high consumer credit growth contributing to increased demand and overall economic activity. Now let's discuss how understanding trends in consumer credit growth can help you make better financial decisions. By monitoring these trends, you can gain insights into broader economic conditions and anticipate potential changes in interest rates, allowing you to plan accordingly. This approach encourages being proactive about your finances rather than reactive. For instance, if you observe that consumer credit growth is slowing down, it may indicate a shift in economic conditions where lenders could become more cautious and offer less favorable terms for new borrowers over time. Understanding such trends can help individuals prepare for potential changes in the lending environment. So what's the takeaway? Understanding consumer credit growth can help you gauge potential economic risks and opportunities. It's like having a weather forecast for broader economic conditions, helping you to plan ahead and stay informed about financial trends. Now let's summarize. Consumer credit growth is significant because it indicates how much consumers are spending using borrowed funds. This has substantial implications for both individual financial health and the overall economy. When borrowing exceeds prudent levels, it can increase risks and potentially threaten economic stability. Here's a quick recap. High consumer credit growth can indicate strong consumer demand and economic activity, but it also signals potential risk if not managed properly. This trend impacts interest rates, inflation, and overall economic cycles. By understanding these dynamics, you can better educate yourself about your own borrowing and spending habits. This is educational and historical, not financial advice. Consumer credit growth isn't just a number on a report, it's a snapshot of how consumers are handling their finances as a country. When this figure spikes, it often indicates that people are taking out more loans for large purchases like cars or homes. However, if too many individuals are borrowing heavily to maintain spending levels, it can become unsustainable over time. Think about it like this. If you max out your credit cards every month to buy things you don't really need, eventually those debts pile up and interest payments can consume a significant portion of your budget. The same goes for the economy as a whole. When consumers borrow too much, they might struggle to repay their debts, which can lead to defaults and economic downturns. On the flip side, moderate consumer credit growth can indicate confidence and spending power among consumers. When people feel secure enough to make large purchases using credit, this boosts businesses and helps keep money circulating in the economy. However, it's crucial to maintain a balance. If you're considering taking out a significant loan, it's important to evaluate whether you'll realistically be able to repay it without experiencing financial stress. Understanding these dynamics can help you avoid getting caught up in risky borrowing habits. It's about making informed choices and keeping an eye on your debt levels. Remember, the goal is to borrow only what you need and can comfortably repay. This way, you stay ahead of potential risks and maintain financial stability. This is educational and historical, not financial advice.